Hey everyone, welcome back to Corporate Decoder, the place where we dig through the boring stuff so you don't have to. Today we're cracking open Arteris' latest annual report. Prepare for a wild ride filled with interconnects, automation, and enough risk factors to make your head spin. We will make the journey worth your while and hopefully fun. Arteris, in a nutshell, makes technology that helps computer chips talk to each other faster and more efficiently. Think of them as the traffic controllers inside your phone, your car, even your data center. They reported their yearly performance for 2024, so let's break down what that means, what to look forward to, and their potential obstacles. Arteris operates in a growing market. As chips become more complex, packing more and more processing power into smaller spaces, the need for efficient ways to move data around inside them becomes more critical. That's where Arteris steps in, providing intellectual property or IP solutions that manage this on-chip communication. Their technology is used everywhere from cars to computers to communications equipment. Now let's talk numbers. The report states that as of late June, the value of shares held by normal investors, meaning not the big bosses, was around $202 million. This is the amount of shares in the market available for purchase. This amount influences share prices and company valuations. For the whole year of 2024, Arteris brought in almost $58 million in revenue. They have been growing their business to add 10 new customers in the year. However, it's not all sunshine and roses. So they also reported a net loss of about $34 million for the year. This means they spent more money than they made. We'll dig into why a little later. A key metric for Arteris is something called annual contract value, or ACV. Basically, it's the average amount of money they're making each year from their contracts with customers. As of the end of 2024, their ACV was around $61 million. If you add in royalties payments they get when their customers sell chips using their technology, that number jumps to $65 million. This is an important value to consider when comparing to the net loss. Now, who's buying all this technology? Their main markets are automotive, enterprise computing, think data centers, communications, consumer electronics, and industrial. Arteris notes, for example, that the automotive market, with its move towards self-driving cars and electric vehicles, is a big opportunity for them. This is because these fancy cars need increasingly complex chips to handle all the new technology. What makes Arteris special? They claim it's a few things. First, they help customers get their products to market faster. Second, their technology helps improve the performance of chips. Third, they argue that they can lower customers' research and development costs. They also have a large team of engineers and are coming up with new stuff all the time while growing their business by selectively acquiring others. Of course, it wouldn't be a Corporate Decoder episode without a healthy dose of risks. This report lists a number of challenges that could hurt Arteris' business. Here's the short list. Competition. They face stiff competition from bigger companies and even their own customers who might try to develop these chip communication solutions themselves. Losses. They have a history of losing money and there's no guarantee they'll become profitable anytime soon. Market acceptance. If their customers' products don't sell well or if companies don't adopt their technology in the first place, Arteris is in trouble. Politics. Changes in US trade policies, especially with China, could throw a wrench into their international operations. Design wins. They spend a lot of money trying to win contracts to get their technology designed into chips. If they lose out on those bids, it's a major setback. Intellectual property. They could get sued for infringing on someone else's patents, or their own patents might not hold up in court. International operations. Doing business overseas comes with its own set of headaches, like currency fluctuations and political instability. Regulation. As if all that wasn't enough, they are subject to a whole mess of government regulations, including export controls and data privacy laws. This can be difficult and costly to deal with. To stay ahead, Arteris is trying to grow in a few different ways. They want to keep innovating and developing new technologies, focus on high growth markets like self-driving cars and artificial intelligence, expand their customer base, and if possible, acquire other companies. Arteris' main office is in Campbell, California, but they have offices all over the world, including France, China, South Korea, and Japan. They rent all their office space They are currently involved in some ongoing litigation related to patent infringement claims. Lawsuits can be a drain on resources and can hurt a company's reputation. Looking ahead, Arteris says their success depends on a few key things: getting customers to adopt their technology, the prices they can charge for their products, and their ability to manage expenses. Here's the bottom line. Taking everything into consideration, we need to take a measured view of Arteris. The company has a great product, but we need to consider their ability to grow significantly in this competitive market. The biggest risks lie in their consistent lack of profitability and fierce market competition. The company does not guarantee future profits for the investor, so a risk-averse outlook is expected. On the upside, the increasing complexity of chips is a massive tailwind to their niche services. So, given the numbers from this report, a realistic stock price range for Arteris, considering their growth potential and risks, would be somewhere between $5 and $7. While not yet convinced, Arteris is a company to watch, especially regarding its success in reducing operational costs and competing against giants with its innovative products. Thanks for watching Corporate Decoder. Make sure to subscribe for more easy to understand breakdowns.